Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Hello and welcome to the COB on this Tuesday, Rates Day. I'm Andrew Gagan. Thanks for joining us here at AusBiz to unpack what we've seen across the course of the day, and looks as though we're pretty close to the session lows, where we're going to finish on the SIBO off around 1/3%. A little more exaggerated on the ASX 200, currently off around 0.4%. And of course, all eyes on the RBA, and more recently is on Michele Bullock, having just spoken in response to the decision by the RBA to leave rates on hold at 3.6%. That was expected. It's all about what is to come. Will they hike? Will they continue to leave rates on hold for an extended period? Or is there another cut up their sleeve? Let's get to the themes of the day. On hold, that is what exactly the RBA did. The ASX did struggle across the course of the day as investors just wary, of course, as to where rates are likely to go on. And now attention very much turning to the Fed. That decision will be revealed Thursday morning, our time, with expectations there is a cut coming there, but also questions as to what is to come next year for the Fed. Let's catch up with what we're seeing in the sectors then, in terms of those reaction on the markets, and we can see the financials just a little mixed. NAB having a good day, ANZ also in the green, but the others falling somewhat. Elsewhere, in energy, mostly in the red. We did see the oil price come off overnight. Let's get to the top stories of the day. CBA paying more than $790,000 penalty for breaching consumer data rules. Bapcor, that is the big mover of the day, down 20%, having downgraded its FY26 profit guidance following what it describes as a disappointing October and November. TPG Telecom facing a sentencing committee as scrutiny grows over two incidents in which customers were unable to contact 000. Lithium miner Liontown signing a binding 2-year offtake agreement with Canmax Technologies. Lifestyle Communities will give all existing homeowners the option to switch to its new deferred management fee model. And West African Resources says new drilling at its Sanbrado mine in Burkina Faso points to a potential open mine life extension. Let's now get to the RBA and the market reaction. Martin Crabb joining us from Shore Partners. Martin, welcome to Tuesday.
Thanks, Andrew.
What did you make of the statement?
Yeah, the statement itself was a bit of a bore fest. They did change a lot of the language though. We do this little thing in Word where you compare one statement to another, and there was lots of words crossed out and lots of new ones added in. There was a lot of statements around them feeling a bit more comfortable about the direction of the economy and concern about inflation. They tried to sort of hose that down a bit, but made it pretty clear that they're not in a hurry to cut rates any further, but also sort of buying themselves time. I think they're also making the point that they're transitioning from a well-known, well-understood quarterly inflation read to this new monthly one, and that's going to go from 4 data points a year to 11 or 12 data points a year, and they're not going to jump at shadows too much. So I think that we all freaked out when we saw that 3.8% headline inflation number in October. They said they're just not going to do that. They're going to wait for these patterns to establish, and Governor Bullock used the example of the really weak unemployment number we had back in August, September. Where said the labour market's falling over, you need to cut rates. And they said the same thing. We're not going to jump. Just because we get monthly data doesn't mean we need to act on a monthly basis. So I think they're just trying to cool the market sentiments down, just try and get everyone balanced, and using that word balanced as well in her statement. So I think my reading of it was, the market had a little bit of a wobble in either direction around the statement and the words in the press conference, but generally speaking, we haven't really seen that much of a change to interest rate expectations. So as the futures curve shows there, the market's starting to think about a rate hike in the May meeting, but getting pretty clear as we get towards the middle of the year, we'll have already had a rate hike, and then getting into December and March next year, starting to bake in a 50% chance of a second one. So that's a dramatic difference from where it was a month ago, which the market was baking in an interest rate cut a month ago. So it doesn't take much to move this thing around. generally the statements supported the market's view that the next move in rates is up.
Is it perceived perhaps that the rates where they are at the moment still mildly restrictive?
Yeah, look, I think so. I mean, I've done a lot of modelling on this, and I know the Reserve Bank has also done a lot of modelling on where they think R star is, where's the equilibrium rate of interest. And obviously it's a theoretical idea. No one actually knows. You only really know in hindsight whether you it's like doing a handbrake start. We're old enough to remember handbrake starts in cars, Andrew. You know, you've just got to balance the brake and the accelerator, and it sort of feels uncomfortable. You don't really know where you are with rates and that front. So I think, you know, it's a matter of, is 3.6 restrictive? I think it is. I think neutral's probably closer to 3.25. I think there's another rate or cut or two to get us back to equilibrium, but they don't want to get there because obviously inflation's running too high. So I think if they thought they were neutral, they would probably be talking rate cuts more significantly than they are. The fact that they think that they're restrictive suggests they can stay where they are and things should slow down.
Where does that leave equities then, particularly when you look ahead to the prospect of a potential rate hike or hikes next year in terms of EPS growth?
Well, I think the market is being driven by EPS upgrades mostly in the materials sector. So iron ore hasn't collapsed the way people thought it would. Copper is reaching all-time high. Lithium's, you know, gone from being a basket case to being, you know, back again. We've seen some significant improvements in the domestic economy. Retail spending is going better. Where we're really seeing it is in the small cap. So the black line there on the chart is the next 2 years EPS growth out of the small caps, up to 24%. So, I mean, this is a forecast, Andrew, but it's still pretty bullish. If you look back over the last 20 years, this is probably some of the highest earnings growth that the market's ever expected from small companies. So very, very bullish outlook. And there's obviously a lot of tech companies in there as well that are going from loss-making to profit-making. That's obviously positive. But even the orange line there, which is the ASX 100, we're even seeing earnings upgrades there from probably around 4% in the middle of the year to probably closer to 8%. So we are seeing earnings upgrades. And that's also factoring in the fact that we might get higher interest rates next year. The reason we will get higher interest rates next year is the economy is really strong, which is pushing that earnings. So you sort of can't have both. You can't have strong earnings growth and, you know, flat interest rates. I think you'll get one or the other. But certainly this is what's been driving the market, is not necessarily interest rates, because bond yields have gone a lot higher. Like 10 years have gone from 4.1 to 4.75, and yet the market's moved higher because of these earnings growth estimates.
So, Martin, globally, inflation proving to be a problem. Perhaps not in the US, but we're seeing, for instance, the ECB considering the next move will be up in terms of rates. Of course, all eyes will be on the Fed this week. How critical is it, from what we hear from the Fed expectations, they are going to be cutting? Bearing in mind also that Jerome Powell is not long for the job, and Donald Trump obviously looking to install his man there and be more accommodative with rates.
Yeah, there's lots of moving parts, isn't there? So there's not just where the Fed think they are, where they think the dot plots. So December's a dot plot meeting, so we'll get an update on where they think the appropriate level of interest, I think it's the language they use, what the appropriate level of interest rate is at the end of next year and following. And that'll guide the market on whether you know, there's 4 cuts or 3 cuts or whatever. I think, you know, inflation is being persistent in America because of tariffs. In fact, I don't think the final shoe has dropped on tariffs. I think a lot of people have been wearing them in their margins, and I think they're probably reaching a point where they don't need to do that anymore. So maybe there's another leg up in tariff-induced inflation. In the rest of the world, you know, inflation is reasonably well behaved, hence all the central banks cutting rates. It is a little bit sticky in places like Australia. What we also need to remember, though, Andrew, is there's still a lot of fiscal stimulus going on. Governments pretty much everywhere are running these big deficits, even though we've got full employment. And whether or not they've just, you know, got bitten by the bug of giving money away during COVID, and they haven't got rid of it yet, there is still a lot of fiscal stimulus, including in America. Even though they're putting tariffs in, there's still a lot of spending and tax cuts going on. In Australia, we've had tax cuts, we've had electricity subsidies. I think as governments wind these back, that'll take a little bit out of demand, and that'll probably ease inflation. So I'm probably a little bit more positive on inflation than a lot of people are, because I think that the government's got a lot of room to, as the private sector of the economy continues to gather steam, they can kind of step out a bit. I think you'll see a bit more of that going forward.
Do you want more exposure in the States? Because, in fact, I was just looking this morning, Oppenheimer Asset Management, the most bullish of the brokers on Wall Street, expecting an 18% upside for the S&P 500 by the end of next year from where we are now. We have seen the US market outperform the Australian market. Does it make sense to up your exposure?
Yeah, look, it's a really tricky one because if you look at where all the earnings growth in the world's coming from, it's coming from 6 companies. You know, the top 6, so let's let Tesla out for a minute, going to grow earnings by 22% next year, and that's driving the S&P 500. So the S&P is going to grow at 13. Our market's going to grow at 7 or 8. So these are still pretty good numbers. If you take the AI capex out of that number, it falls away pretty sharply. So I think it's the only game in town, and I think you need to play it. The issue is the US is now 70% of the MSCI World Index. So even a market weight position has 3/4 of your money going into one market. And of that, I think technology is 25 or 30%. So it's a big, big bet. But I think our view, and maybe a top-down view from our colleagues in London as well, is that we need to be overweight US. We need to lean into this growth because that's where a lot of wealth's being created. With one eye on, sleep with one eye open, that great Metallica, we talked about Metallica earlier, that Metallica song lyric, sleep with one eye open. Just be aware that there may be some companies that get overextended. Oracle's one to watch. That they're borrowing a lot of money to do the AI capex, and if it comes undone, they're the ones to watch. So I think there's probably some smart ways you can hedge that risk with some credit defaults and stuff. But we think you need to play the game. So we're not underweight US. We're probably market weight to overweight in our portfolios, and we've got an overweight to technology based just on that's where the growth is. Yes, you're paying up for it, but not egregiously so. We're not back at tech boom PEs of 70 or 80 times. We're at sort of 20s and 25s, which I think's okay. But I think, it's a bit of a widow-maker trade having sold US tech, and there's a couple of fund managers out there that have sold US tech way too early. We're still in the game. We're still playing the game there.
Martin, great to get across what you're seeing in the economy and markets. Thanks for joining us from Short
You're welcome, Adrian.
Let's now turn to our stock of the day. It was Bapcor. That is in the wake of that downgrade. Henry Jennings from Markets Today and Jonathan Takadina from MPC Markets gave us their thoughts.
Is an avoid. If you're looking for bombed out stocks that have potential, there are plenty out there, and you don't have to look at Bapcor, I have to say. So for me, this is just an avoid. Sorry, it's not a good start, I guess, and not a good number that came out from them this morning. So yeah, no reason to be there at all. If you're a holder, you have my sympathies.
18 months ago, a $5.40 bid from Bain Capital, and here we are at $1.88. That was at a $1.9 billion valuation, and now it's trading at about $1.88 at about a 790 mil market cap and losing money. So in sports, generally, if your opponent's making a lot of mistakes, you kind of just let them do it. So yeah, if you're looking for cheap and because there's still a lot of people hanging on to hopes for a takeover at these levels. But yeah, if I was sniffing out a bargain, I'd be like, okay, just let them see if they can fix up the mess. While they keep making these mistakes, you just leave them be. So yes, unfortunately, that's a sell for me.
Well, let's turn to the market leaders and laggards as we have rounded out this Tuesday rates day. Austal is actually top of the list there, more than 3.5%. Mesoblast, the Deep Yellow and the uranium miners that are higher today, HMC Capital and Drone Shield continue to make a comeback. On the negative side, Bapcor, no surprise there, off 20% off the back of that downgrade. NRW Holdings also on that list, down 7%. Linus Super Retail and Catapult on the negative side. In the small caps, in Immutep is up 25% today. We'll get into that news. At MC Mining, EDU and Saluda Medical also. Now, and on the negative side, Energy World has come off 18%. Ecograph, Tolu Minerals and Atomic Eagle. Now, overnight, in fact, this is what we're going to see tomorrow. The Bank of Japan Governor Ueda is speaking. Now, that's going to be fascinating because there is anticipation that the Bank of Japan will be lifting rates this month. US non-farm productivity, that's from the September quarter, and also job openings in the US as well, ahead of the critical Fed meeting. And tomorrow, RBNZ governor, the new governor there, is speaking, and we also get PPI data out of Japan. So to recap, we are finishing on the CBO 200 down around 1/3%, a little more exaggerated we've seen on the ASX 200. It is down 0.45% off the back of that decision by the RBA to leave rates on hold, which remaining with a hawkish bias. That is the COB. Thanks for watching and listening.